So for a look at the economy, the consumer, the Fed, and so much more, we can go a million places this morning. Joining us in an exclusive interview is Wells Fargo CEO Charles Scharf, and we're thrilled to have you at the table on this 30th anniversary week of Squawk Box, no less.
Great to be here, and congratulations to you. 30 years of anything's an accomplishment these days.
Thank you. So the big question is the state of the economy. Yeah. Your colleague, former colleague, Jamie Dimon, says the economy is weakening. Do you believe the economy is weakening?
You know, first of all, I think it's complicated, and I think sound bites are awfully difficult to take out of context. And I put it into two categories. Number one is what we see in our own data. The second is what you see more broadly. In our own data, things are remarkably stable. I mean, we look at, I know you guys have talked about it this morning and other times, consumer spend continues at the same year-over-year pace across almost all wealth levels. Consumer credit is as good as it's been in the last 6 months. In fact, it's probably trending a touch better. Companies are in really great shape. We look at signs for any kind of change, and you just don't see it. Having said that, there is this big dichotomy between higher income and lower income consumers, which continues and is a real issue. And when you look at just the overall data in terms of jobs, it's undeniable in terms of just job creation. So, yeah, things are actually feel very good today, certainly relative to what you think they could be. But it's not equal across wealth spectrums, and there's probably more downside than upside at this point.
So the high-end, low-end consumer spending, you see it, but it's the same as it was a year. It hasn't gotten any worse.
Yeah,
is that
it's interesting what we see is we see fairly consistent spending levels across low-end and high-end, except the low-end is spending the money that they have. So their balances are below where they were pre-pandemic levels. But they are living on the edge. Hasn't impacted credit yet, but they're certainly not becoming more healthy, and the affluent customers are bringing up the averages.
Here's the weird thing. If consumers are still spending and businesses are still printing record earnings, stock markets at new highs, you would think businesses would be more inclined to hire people.
Right.
Why do you have the jobs picture looking as weak as it is when businesses, you would think, would be feeling pretty good about things?
Yeah. Well, listen, it's hard to exactly know. What I would say, we spend a lot of time talking to our middle market customers across the country. And I think certainly tariffs do have an impact on it, which is that, well, back up. It's actually very interesting. When you go around the country and you talk to middle market customers, doesn't matter whether you're in a red state or a blue state, what you hear is more business owners and people leading these mid-sized businesses happy that this country is dealing with the trade inequities that have existed. So they feel good about that. They're willing to deal with the uncertainty, but they need to react to that. And so part of that is just being very prudent in how they're hiring. And so, that certainly seems to, be dampening, the increase in jobs. And then beyond that, there's the whole AI revolution. I personally think we're still so early in the impact of AI that it's hard to actually believe that that's the meaningful driver today.
Right. When you've thought about job count, employment, have you gotten to a point where you said the AI is so good that we can actually scale back in terms of new hires, for example? Are you there yet?
We're just starting to get there. I mean, you're starting to see it in those places where it's easiest and most obvious. Within technology, in terms of coding, I mean, the efficiencies you can get by using the tools today are significant, and you can either get a lot more productivity and have the same number of people, or you can deal with less people. We're growing our tech budget, so for us, it's less about having reduced headcount in technology, and more about just being able to get more done.
In terms of the credit score, if you will, of America, when you look at just how people are either taking on debt or not, in regards not just to mortgages, I'm talking about credit cards and the like, how much of that is a feature of what's happening in our economy?
Well, it looks like when you look at what's happened in the credit spectrum, that the financial institutions have been fairly prudent about not allowing people to overextend. So when you look at our credit card growth, we've grown substantially over the last 4 or 5 years with new products and whatnot, gone from 35 billion to 50 billion in receivables. That number has actually kind of leveled out over the last couple of quarters, partially because we've tried to be very prudent about who we extend credit to, but also because payment rates are very high. So, certainly the credit segment where we participate, I think, financial institutions have been quite constructive.
So you don't believe that people are sort of overextended in some other way that we don't know about? You've read, over the summer there were a bunch of these articles about how maybe parts of the country were
you just don't see it in the
living
results.
beyond their means.
You just don't see it. Again, when we look at early stage delinquencies across all the different folks that we lend to, it looks good.
By the way, as a bank, how do we have this Klarna IPO coming up? Mm-hmm. How do you think about the sort of buy now, pay later, and all of the sort of fintech companies that have come on that effectively are trying to compete away some of the more classic legacy businesses?
Yeah, listen, it's competition. It's competition in lending. There's competition in the deposit space. Our view in terms of what we do and the benefits that we bring is it's a broad relationship. So it's not just about the credit card loan. It's not just about the mortgage. It's about all the things that we do, and I think that's one of the huge benefits that a substantial institution like ours brings is we can provide a broad set of advice and help you both on the deposit side, the loan side, investments, and all the other things that you need.
The people who are naysayers and concerned about some of those fintech companies would say, hey, they don't know how to price loans appropriately. Do you share those concerns, or do you think
listen, I would say the following. I think when you look at consumer markets and when you look at wholesale markets, there's a huge amount of liquidity available for loans, right? And whether it's in the public space, the private space, not everyone has been through a cycle. And I just think that, yes, some people understand it better than others. I don't know who really understands and who doesn't, but there will be casualties for sure.
When there's a
cycle, which there will be a cycle. Pretending that there won't be a cycle is just crazy.